In this video, we're going to reveal powerful, proven investment strategies that can take anyone from a complete beginner investor with very little money to building multimillionaire level wealth by the time they reach their mid-30s, and exactly how you can apply these same approaches in your everyday life. Let me explain it to you, step by step, with additional details, so you truly understand the why behind each strategy and how to implement it effectively in your own situation. Imagine gradually but securely transforming your financial situation, avoiding the common mistakes that trap so many people in cycles of frustration and stagnation. So here's a simple but profound question for you. Do you want to be rich and enjoy the total freedom that comes with true financial stability? Most people desire it with all their heart. Why do you think there are so many get-rich-quick schemes everywhere, from social media ads to late-night infomercials? Unfortunately, the vast majority of people have a lottery mentality. They're just waiting for some miraculous stroke of luck, like a magic fairy, to drop $1 million in their lap out of nowhere. Does that sound like a reliable, sustainable long-term plan to you? If the answer is no, and we really hope it is, because the reality is far more empowering, then smash that like button right now to show your support and commitment. The harsh truth is that many people naively believe winning a big sum of money will make all their problems vanish like magic, but they'll get an absolute devastating shock. Without the right investment strategies and a solid, disciplined mindset, that money will evaporate quickly, and before you know it, you'll be back at square one, or even worse off. What you really need is a solid, consistent, well-structured investment plan that builds your wealth gradually but exponentially over time. Long-term investing not only delivers impressive returns, but also gives you peace of mind by minimizing unnecessary risks. Think about it. Many successful investors started with passions they couldn't afford at first, like dreaming of becoming a race car driver and loving everything about high-speed vehicles, but lacking the funds to pursue it. However, as they built their investments intelligently, it allowed them to compete in multiple professional championships, win countless shiny trophies, and even display racing gear in the background of their content, like a custom helmet, symbolizing past victories. How cool is that, right? Not only that, strong, well-managed investments can free up valuable time for creative and fun pursuits, like producing educational finance videos without the pressure to monetize them directly, letting you focus on delivering pure value to your audience. And you can relax completely because this video isn't about selling you anything at the end. It's pure actionable information for your benefit. There are so many investment options available in today's market, from traditional stocks to emerging cryptocurrencies. It's incredibly easy to get distracted by the next shiny object, promising instant riches, like a new trading app or viral token. Plus, it gets confusing and overwhelming when you hear experts or influencers telling you this is the best thing right now, the latest and greatest, and that if you don't invest immediately, you could miss out on thousands of opportunities. You probably heard of Bitcoin, penny stocks, and short selling, but the fundamental key to success is not getting overwhelmed or distracted by these fleeting trends that come and go, like fads. Now, let's face it once and for all, you're never going to be an absolute expert in everything related to finance and investing. No one is, not even the gurus with decades of experience. And if you keep constantly changing your investment strategy, chasing the new thing without consistency, you'll end up with less money in your pocket, and eventually you'll make a big, costly mistake. I have nothing against experimenting with small amounts to learn, but keeping your main investments very consistent over the years is crucial for sustained growth, and it's wise to invest large sums only in things you fully understand, researching thoroughly before committing. No one claims to have all the universal answers, but the goal here is to be completely transparent about proven strategies that have led to multi-million-dollar net worths based on real business experiences. Remember, this comes from practical business experience, not as a certified financial advisor. So, it's not formal financial advice. It's simply what has worked effectively to build lasting wealth, and you can adapt it to your personal situation with caution. First, you need to intentionally and strategically create more disposable income. At the end of the day, you need real money to invest, and the more you have available, the better, especially in your 20s and 30s, when time is on your side thanks to the power of compound interest. Now, a lot of people will insistently tell you, save, save, save at all costs. Don't go out with friends. Don't buy that expensive coffee. Don't get that nice car you want. I'm not fully on board with that restrictive, depressing mindset. Of course, saving is a big and essential part of it, but you also have to enjoy your life along the way. Otherwise, what's the point? There's no reason to make yourself miserable just to save a few extra dollars that won't make a significant difference. Instead, you should focus most of your time and energy on proactively increasing your income. You can do this by learning high-demand skills in today's job market, like programming, digital marketing, or online sales, starting a side hustle alongside your main job, like freelancing on platforms such as Upwork or selling products on Etsy, or building a scalable business that grows over time, like an e-commerce store or a content channel. You don't have to settle for the fixed salary from your 9-to-5 job. That's limiting. You need to dedicate time to finding creative ways to supplement it or, ideally, replace it entirely with more lucrative and passive income sources. For example, many people in their early 20s realize that a low-paying job, like earning less than $3 an hour in manual labor, such as carpentry, will never give them enough to invest. Meaningfully, it barely covers basic monthly bills. That's when starting a journey into the business world becomes essential, exploring opportunities like startups or commercial partnerships. Investing in business really go hand in hand, complementing each other to maximize results. The saying is absolutely true. The more you learn, the more you earn, and most importantly, the more you can invest in wealth-generating assets. Be really conscious of your lifestyle and make sure to keep it in check, avoiding lifestyle inflation. That ruins so many. Just because you're earning more doesn't mean you should spend more on unnecessary luxuries. Think about someone like Ed Sheeran, for example. He has an enormous fortune, but keeps his lifestyle modest and balanced. He still enjoys life's small pleasures without splurging. If you were happy, earning, say, $40,000 a year, and you manage to increase your income to $100,000 a year, that means you have $60,000 extra. These should go straight into a high-interest savings account and then channeled into your priority investments. You don't need to spend them on impulsive whims. Well, there's a slight exception to this rule, and it's stage number 2. Pay off all your high-interest debts as soon as possible. If you have accumulated student loans, credit card bills with exorbitant rates, or even payday loans with predatory interest, these debts are dragging you down like an anchor. They're destroying your credit score, ruining your ability to access good, affordable loans in the future like mortgages or business financing. By paying off these high-interest debts first, you'll actually save more money long-term than you could expect to earn from any other investment because you avoid the negative compounding of interest. The next stage is creating a freedom fund, which is basically an emergency fund that gives you back power and control over your financial life. This freedom fund should consist of 3 to 5 months of basic living expenses, covering rent, food, utilities, and essentials. It protects you if you decide to quit your job for something better, as well as in a multitude of other unpredictable situations like economic recessions, global depressions, or even worldwide epidemics that disrupt everything. Imagine the peace of Mind knowing you have a cushion that lets you make bold decisions without panic. Okay, so you've increased your income by learning a high-demand skill or perhaps investing in your own business with dedication. You've kept your lifestyle in check to avoid overspending, paid off all your debts, and built a solid freedom fund. Now, and only now, is the ideal time to start exploring other investment options with confidence. Let's begin with the lowest risk option, index funds. An index fund is a diversified collection of investments where you put your money and own a percentage of the whole thing, like taking a slice of a pie. This gives you fantastic diversification and protects you from poor individual stock picks that could fail. For example, suppose you have $1,000 and invested in, say, Apple stock because it's a big, supposedly safe company. As soon as you invest, the company faces an unexpected setback, causing the stock price to plummet drastically. The result could be losing most of your investment in a blink. That's where index funds come to the rescue. Instead of owning just Apple stock, you could take those $1,000 and invest in something like the S&P 500, giving you small stakes in Apple, as well as Microsoft, Amazon, Meta, Visa, Disney, and many more leading companies. Suddenly, you're a shareholder in all these major world companies. Now, if something happens to Apple, it would be balanced by the positive performance of the other investments in your index fund, minimizing the impact. Now, a lot of people will try to convince you that a mutual fund is superior and more sophisticated. A mutual fund is very similar to an index fund, except it's controlled by a very smart person, a fund manager, whose job is to precisely select the stocks in the fund. The purpose of a mutual fund is to try to beat the overall market and get better results for the investor through expert decisions. However, in the vast majority of cases, you'd be much better off putting your money in a simple index fund with less risk involved and often higher long-term returns. Why? Because index funds charge extremely low fees, like the S&P 500 charging just 0.07% annually. In contrast, mutual funds charge high fees, between 1% and 2% of your account balance every year. If you invested $10,000 in a mutual fund, then $200 would go straight to the fund manager's pocket each year, even if their poor choices make you lose money. On the other hand, with the same amount in the S&P 500, only $7, yes, just $7 would come out of your account annually. This is because index funds are passively managed, tracking the market instead of trying to beat it, and therefore don't have to pay a manager who might or might not be doing a good job. For long-term investing, many people love using Vanguard index funds because they're incredibly easy to use and beginner-friendly. No affiliation here, just genuine appreciation for how efficiently they work. It's also smart to diversify even further by mixing in some international funds and bonds, which act as a cushion in volatile times. The older you get, the more bonds I recommend investing in. And no, I don't mean James Bond, though he's pretty cool with his impeccable style. The investment method that often gets the most focus for building substantial wealth is real estate. Many successful investors prefer real estate far more than stocks because it involves tangible assets you can see, touch, and control directly, though it's acknowledged that buying properties with little initial money can be challenging, but it's definitely something worth saving for with discipline and patience. A first property could be something modest like a one-bedroom apartment costing around $50,000, and renting it for $500 a month generates consistent passive income flow. Holding such a property for about 10 years could lead to selling it for $150,000, multiplying your investment and igniting a healthy obsession with the unlimited earning potential in the real estate sector, from value appreciation to monthly rent. Now, this is a good time to decide what type of investor you essentially are. The first type is the capital gains investor. This person loves buying low and selling high, pocketing the difference as quick profit. They're investors, interested in acquiring houses at auction bargain prices. Or perhaps you've seen signs outside announcing, "We buy your house for immediate cash." They take advantage of situations where people need quick sales for reasons like urgent moves or inheritances. Then they might move in temporarily, renovate the property with smart improvements, and flip it for a juicy profit. They have to repeat this process continually to maintain momentum. This can work extremely well in bull markets, but it's subject to annual fluctuations in the real estate market, like bubbles or economic crashes. The second type is the cash flow investor, a popular approach where the emphasis is on ensuring rent fully covers a mortgage payment and generates surplus. Following the 1% rule is key. What it means is that if a property costs $100,000, it should bring in at least $1,000 a month in rent to be viable. Otherwise, honestly, it's not worth pursuing because it wouldn't generate the desired return. Now, let's talk about one of the riskier options, individual stocks. Questions about this type of investment come up daily, and it's understandable why it attracts so much. Individual stocks are a very attractive choice for many people because with small investment, you can enter the market and sell whenever you want. Unlike real estate, where you have to find a buyer, negotiate, and go through the whole legal sale process that can take months. With stocks, at the touch of a button, you have full access to your funds immediately. Many investors in their early 20s look at a few promising companies and invest something like $5,000 in individual stocks and shares. That can be a significant sum at that stage of life, and within just 6 months, it could turn into a $100,000 profit, which then could finance something bigger like buying a large warehouse to push a business forward with expansion. Always make sure you deeply understand what you're investing in. Research the company, its business, model, competitors, and sector trends. I see many people investing in stocks just because their friends recommended it without thinking twice. If you don't understand, it's simple. Don't invest to avoid unnecessary losses. There are two main methods for effectively valuing a stock. The first is called quantitative analysis. Something that might surprise you is that when you search for a stock price on Google, that's not the absolute real value. It's more a momentary market estimate. I like to examine the company's quarterly earnings reports, which include elements like balance sheets, detailed revenues, and cash flows to get a real grounded feel for the company's intrinsic value. You can find this information easily online through sites like Yahoo Finance or the official SEC site. The second method is qualitative analysis. This isn't about raw numbers, but the abstract, intangible qualities that make a company truly great and unique. A good example is Tesla. There's something special about Tesla, from its visionary CEO, Elon Musk, to the enthusiastic fans who are its loyal customers. It's also wise to consider a company's future value based on how its technology will integrate into the modern, evolving world. I firmly believe the shift to electric vehicles is inevitable and accelerating, and Tesla is at the forefront of this industry with the most extensive supercharger network and innovative product availability leading the market. If you decide to go the individual stocks route, make sure to create a diverse and balanced portfolio. Don't limit yourself to one sector. You have to use different areas like health, technology, renewable energy, and several others to spread the risk. You really don't want to be exposed to massive losses if an entire sector collapses, like what happened with the dot-com bubble or the 2008 financial crisis. If you're interested in diving deeper, there are excellent books available. Links can be found online or in recommended resources sections. You can trade this on user-friendly apps like M1 Finance, Robinhood, and if you're in the UK, Free Trade, which make the process accessible even for novices. Many investors prefer to control and add value to their investments personally and actively, seeing exactly how their money is spent, and using their accumulated experience, contacts, and network to strategically tilt the odds in their favor. This finally leads us to private business investments, which allow mixing stock buying with your own business expertise. Think of shows like Shark Tank or Dragon's Den, but on a much smaller, more accessible scale. Opportunities often come through professional networks, like a connection in China offering stakes in a new hotel supplies business. This could involve traveling to inspect the supply chain in person and opening doors in English-speaking markets with your local knowledge. The advantages can include access to building materials or even items like a jacuzzi during home extensions, though that might lead to casual, fun content ideas in the future. This is just one of the many ways improving your skills and contacts can be a great investment, as it lets you secure much better deals than just offering pure cash. Sometimes it can even lead to free shares in another company as a bonus. Building wealth is a team sport, and you've just taken the first step toward winning the money game. If this roadmap gave you the clarity you've been looking for, show your support by hitting that like button. It tells the algorithm that financial freedom is a priority, helping us reach more people just like you. Don't leave your financial future to chance. Subscribe to the channel and tap that notification bell right now. We are dropping the exact strategies you need to master your capital, and you don't want to be the one who misses the next big move. Knowledge is only power when it's shared. If you know someone who is tired of the 9 to 5 grind and ready to level up, share this video with them today. Let's build this legacy together. What is your number one financial goal for this year? Drop a comment below. I'm reading your responses, and I want to see you win. Thanks for watching, and I'll see you in the next one.